Well, good evening, ladies and gentlemen. I hope you're very well this evening. It's a beautiful late afternoon in Perth, and I hope all is well where you are. My name is Mike Smith. For those of you who don't know me, I know many of you do, looking at the attendees list. So welcome, whether you're new to me as an educator, or whether you're a regular visitor to some of the education programs that we run. Fantastic to see you here. Hey, Mark, how are you? Great to see you here, buddy. And yeah, look, I'm going to put together a case, a bit like some sort of trading forensic sort of expert in terms of trying to unpick what's happening to gold. We are fairly close to 10-month lows, and probably one of the major questions that I've been asked on webinars over the last couple of weeks is it time to buy gold? And we'll look at the reasons why that might be attractive, but we'll also be balanced with this and look at the reasons why that may not be such a good move for right now. But obviously, much of it depends on your outlook in terms of where you see gold going, not only in the short term, but also the medium and long term. So what we're going to do is going to pick it all apart and then give you the facts of the case, Your Honour, and let you make your own decision. Now, just a couple of important messages within this. Obviously, it's delivered by myself, so the opinions expressed are mine and shouldn't necessarily be seen as being representative of gold markets. And obviously, we are going to look at live markets as well, so please bear in mind this is for educational purposes only, not direct advice to enter or exit any position. You need to look at your own trading plans, your own trading objectives to decide what the right choices are for you. So I hope that all makes sense. Just if a couple of you can just type in, make sure that you can see and hear me okay, that would be great, and we'll get things moving and get into the session, which is probably going to take around 45 to 50 minutes. Now, just a couple of other things. Thanks, Joe. Cheers, Mark. Thanks, John. Cheers, Greg. Just a couple of other things. I tend to not soft soap anything. I'll tell you how it is. Most of the guys who again know me have known me for a little while know that that's the case. I don't see any reason in painting any pictures that aren't what the market is telling us. Thanks, Stuart. And of course, the other thing, I want you to be able to feel free to ask questions or make comments at any time. My purpose here is to make sure that you go away with some information that's useful, that you can decide as to whether to take action or not take action for yourself. And so please ask questions. Even if they appear to be pretty basic, then it's very allowed. Okay, Jeffrey, anybody else finding the sound cutting in and out? Just let me know if that's the case for where you are too. I've got one person who's suggesting that's the case, and I just need to find out whether it's a local issue or whether it's something that, no, we appear to, Jeffrey, it might be something local, it might be a bandwidth issue where you are, or something different, but bear with us. And hopefully it'll rectify itself locally. Okay, so let's look at the facts. Okay, in August 2020, precious metals hit record highs in the post-COVID recovery, and gold traded over $2,000 an ounce, rising almost 40% in 5 months, so a staggering run higher, and silver was trading at almost $30. Now, fast forward 6 months to where we are now, both of these are down around about 16%, but interestingly, both off their recent lows. So this obviously raises the question, and this is what the topic is for today, is what next for precious metals, and perhaps thanks. So we've got Luke and Alyssa going okay now with the sound. That's great. Thanks for your feedback, guys. And of course, how best to trade precious metals. So let's just look at some charts here and just very quickly. Okay, we're going to come back to these on regular occasions. So this is what happened post-COVID. So I'm just going to shift this to the side a little bit. So just so you know, this is the this is an MT5 platform, but it's exactly the same as MT4. You can trade gold and silver on both. It is the CFD, so it represents the gold and silver futures contract, not the spot price. And the futures contract is forward dated, not the next expiry, because there's all sorts of issues going on if you try to do the next expiry. So this is what we saw post-pandemic. I'll even take this back further again. Let's just take this out a bit. So in February, March, where everything hit, we got this big drop of around about 14 or 15%. Okay, so that was really in response to people cashing up. So normally, if there's a major shock to the market, you'll often see buying come into gold, and we'll talk about this in a little while. But on this occasion, people were cashing up and preparing themselves for the impending disaster and depression that was predicted to happen. Of course, from then we got an incredible move higher. In excess from the lows that we hit there, as I said, of 40%. And so a couple of things that we can talk about is what created this staggeringly positive up move, and then what's happened since. So most of you who have been to sort of my sessions before know I've been a gold bear ever since September, and not seen any reason to get into it. But now at these levels, it looks interesting, and we're going to come back to this, but I'm just going to put this line on a chart, and you can see why this line might be interesting. And even if you put it on a line chart, you can see how it was support here, here, and here in March through to June, before it popped higher in June, and then hit its lows earlier this month. But we've had this 4% near bounce at this stage. Okay, so that's just to paint where gold has been. Silver, a slightly different picture on this. I'm just going to take these lines off because they're just making things a little more difficult to see. Let's get rid of everything, and we'll put some things back on later. Let's again just take it right out. So silver was up in excess of 150% from its low. That was quite staggering. Now, why is that? Well, there's different investors in silver and gold. Invariably, silver, gold is held by a lot of gold is held by central banks and institutions. Silver, although there's some institutions, is often used as a hedge for gold with banks, but is because of its pricing, it's in the $20 mark, is popular with investors too. So that was why we got that exaggerated move up, but we'll come back to that. But once again, you can see we are off our lows. Interestingly, over the last month or so, we've had a lack of parity between what gold and silver are doing. But essentially, it dropped at its worst, down about 27%, but now sits, as I said, around about the 16% down from its highs. Stuart, yeah, look, the Reddit traders that influenced GameStop, yeah, there was one point that happened, and this was this point here. So towards the back end of January, we had this major spike, a retest of a high. The length of that bar is quite staggering. From top to bottom is around about 8% in a day, and was in fact from high to previous close at 10%. So that was that trade that you're referring to, but really that was a short-term thing. Really only lasted a couple of days, not quite as lengthy as the GameStop games that were going on. But yeah, good point. Okay, so that's where it all sits now. So what? So I guess the question is, why is the case for precious metals interesting? So what we've seen after the recent sell-off is we've seen a stabilization and certainly with gold a move higher despite traditional logic related to what moves precious metals, and I'll talk about that in a moment. So one of the questions, as I said, I've been asked regularly is, are the planets aligning for another push higher? And what may be, that's not my end, I don't think, Greg, sorry about that. Have a little play with that. Shouldn't have decreased. I'll just check what people can see. No, it's still at full pelt, my end. So it makes sense, as I said, there are many factors that influence gold and subsequently silver prices, and it's really the interplay of these which will move value up and down. So we're going to look at the critical, actually I've made 5 in more detail and their potential future influence on price. So put the case together and therefore we can sort of start to plant our flag in what may be the case. I'll be talking about that, G, in a moment. So factor 1 and the major factor in the price of gold is the strength of the US dollar. So there's a historic inverse relationship between USD and gold, i.e. when USD goes lower, then gold goes higher, and vice versa, of course. So we can sort of see this if we pop back to the charts. Usually this would be the case. So in that period of time where gold has dropped from its highs, so if we go back to September, October, we've actually moved down in the USD, as well as obviously moving down in gold. So that traditional relationship, although fits on a day-to-day basis, in terms of a medium-term trend, the two actually look not that dissimilar, which is interesting. So that traditional relationship has been in and out of vogue, and in fact, if you look at the last, really since the beginning of Feb, if we look at the US dollar, which now is at a very, very interesting place. You can see that 200 MA on the daily chart, which it's testing right this moment. In fact, if we just pop that line on where the 200 MA is at 92.60, you can see on the hourly chart that we're actually giving that a good test right this moment. So that's interesting. And this was despite all the doom and gloom about how the US dollar was going to get smashed into oblivion because of all the stimulus, which obviously hasn't occurred. In fact, the reverse has been the case since the beginning of the year and the Biden administration coming into power. So despite that 1.9 trillion stimulus package, the US dollar has actually gone up. And I'll explain why that is in a moment. But of course, with the US dollar going up since the beginning of Feb, let's look at where gold is as well. And you can see there's been that 4% move up again since mid-Feb. Okay, so that traditional relationship isn't really playing out very well at the moment. Now, that's not to say it's not going to come back in, and on a day-to-day basis, we still see that, and we'll still see some evidence of that. Now, normally when that happens, we're getting, if you see gold and USD moving together, it's deemed to be potentially a flight of safety, which we'll talk about at the moment. But again, that doesn't really hang together as a theory right now. And this is why people are getting very interested in what's happening. So what's happening generally is the level of global stimulus to support the economic impact of COVID-19 is going to have a price to pay. Okay, and this will be seen ultimately in inflationary pressures theoretically for many years. And that was one of the primary drivers that was pushing gold up so significantly during the middle part of 2020. Central banks, in particular the US, are piling all of this money in That's got to mean weakness for the US dollar in the long term. That's got to mean massive inflationary pressures going forward. Of course, we've got no inflation whatsoever at this stage, and that is the way it is, and that's the way it is globally. And despite some of the thinking about that, there's two other things that are going on. The Fed is likely to remain very accommodative in terms of, and the US government, because of the Democrats getting in. So there's likely to be both fiscal and central bank support of economic recovery, with no prospect of interest rate rises till 2023 and possibly even late 2023. And again, the Fed have come out and said, well, look, we're actually quite happy for inflation to pop higher, possibly as high as 2.5% before we start to get upset about it. So the CPI data, if we look at it, is actually historically low globally, and in the US is only 0.1. Okay, so a long way off 2.5. Now, what is happening, however, is that US Treasury yields, the bond yields, particularly the 10-year, which is of most interest, have started to move higher. In fact, not started to move higher, have moved significantly higher in the last few weeks, and that's put pressure on equity markets. So generally speaking, we've got an institutional investor, managed fund, for example, who says, look, where am I going to put my money to get some sort of safe-ish return? We can put it into bonds, but we've only got, it's down to 0.3% on the 10-year, which is nothing. It's not even worth, you might as well have it sitting in cash. Or we've got a 4 or 5% dividend yield on stocks. So what happened was that money went into stocks, and now we're seeing Treasury yields rise to around about 1.6% now on the 10-year. But we're not seeing that reflected in inflation at this stage. So it's one of the reasons that equity markets are a little bit nervous right now, a little bit of caution with stocks, because the higher the Treasury yields go, the more attractive they are to institutions, and we're more likely to get institutional money going into them rather than into stocks. So there's a little bit of a balancing act going on at the moment, but things seem to have stabilized right now. But stabilized for how long? The Fed may well intervene on Treasury yields. They can buy and sell Treasuries to try and influence rising yields, to keep them under wraps. And of course, every time they come out and say, well, look, no prospect of interest rate rises is going to keep things down. So most analysts right throughout the last year have been talking about the demise of the USD. That hasn't happened. Although, remember, everything that is known already is priced into the market. So a post-COVID recovery is starting to be priced into the markets, with vaccines being put into arms. Obviously, the stimulus package that has just been passed, even though checks haven't been written yet, is priced into the market. But the likelihood is, and the market thinking is, that this is not going to be it, that there's going to be more central bank intervention, more fiscal intervention in the US to support infrastructure spending, which is, of course, is going to create jobs. And in a time where jobs have been significantly put under pressure because of COVID, that is the general idea behind what the Biden administration, in terms of getting the economy back rocking and rolling as quickly as possible. So that potential for more spending, for more money printing, as it's sometimes called, will undoubtedly come back and create an inflationary environment which could send the US dollar down, and because of that inverse relationship, could send gold higher. However, no sign of that as yet, no sign of that in the foreseeable future, certainly over the next few weeks, but watch those Treasury yields. We talked very briefly about flight to safety, gold seen by many central banks as a safe safe place to have money in times of economic and political upheaval. And what tends to happen in that case is money goes into the two historically safe assets, which have historically have been the US dollar and gold. And that's often when you'll see them move together, and when that calming down occurs, you'll see them both move down together. Whether there's some of that going on right now, as we see signs of economic recovery, certainly in the data, then that can be the case. But we suggest that it's not. So if the money's not going into gold, where has it gone? Well, I actually referenced it on the previous slide. I actually never mentioned it. The popularity of cryptocurrencies, which has now been backed up by what I'm terming to be institutional credibility, and that institutions are now investing in cryptos, may mean that the cryptocurrency is now seen as another and possibly more attractive inflation hedge than gold. So we've also, as I said already, we've got a promise of further intervention as needed. So we've got a really soft environment to allow the economy to grow as fast as it possibly can in this particular case. Obviously, we had a little bit of a blip this week. We had the re-emergence of increased cases, deaths, and lockdowns in Europe. And it's in a race. There's a race going on between that happening and, of course, how quick we can get vaccines in arms, which is obviously due to availability and distribution efficiency. But the impact on sentiment seems to be limited. It was a one-day event in terms of where the market was. So 3 days ago, this was the reason markets moved significantly to the downside. And we saw the stocks which benefited in COVID, like Zoom, like Netflix, like Amazon, all spike higher, and then they all dropped like a stone yesterday. So it was a one-day event. So that doesn't appear to be a major impact on sentiment. So bottom line is, there's no flight to safety. Okay, production cost factor 3, obviously, gold is a finite resource, and quite simply the costs involved in extraction and production of gold are higher, as most of the easier precious metal mining has already been done. So getting gold out of the ground becomes historically more expensive, and that obviously has an influence on price. And it's simply going to get worse going forward. So these ultimately are bound to influence price in the long term, but at this stage are not a major driver, as there's less companies actually extracting and producing gold at the moment and silver. We look at gold use, which is factor 4. So traditionally, jewelry has always been part of the major use of gold. But other areas are becoming more significant, and I'll talk about these in a moment. But obviously, despite the economic concerns and the perceived reduction in discretionary spending, that should be spending rather than pending. Apologies for that. Let me just correct that with a little S there. Spending. There are other factors. So the gold use is dropping in terms of jewelry, etc., but increasing in both technology. Gold is used in many innovations in electronics, and of course their products are now almost seen as consumer staples rather than discretionary. A few years ago, the latest iPhone may have been seen as a luxury item, but these days it's almost seen as a necessity by a large part of the population. So there is no reason to suspect technology is not going to continue to go where it's been for the most part. There will be pullbacks and corrections like there was recently for a couple of weeks. There's also newer interventions using gold for various sort of biotech issues, such as delivering drugs into the human body, catalysts that can purify water, all of which are going to increase over time. But these are a really small player in terms of gold usage at this stage and won't influence price in the short term. So these things are an over months and years issue rather than a shorter term thing. As we see the economy recovering, perhaps we'll get some more discretionary spending into things like jewelry, and that may help gold price going forward. But at this stage, it's at quite a low ebb, and that's possibly one of the reasons why we've seen gold drop off. So we're yet to find a compelling factor looking at those 4 areas that says gold's a compelling buy right now. So let's look at the technical side of things in a bit more detail. So we've already sort of referenced the recent history of gold, and market sentiment is forever changing the short medium term as individuals, but more importantly institutions and banks reposition their particular holdings. Now, the other thing to say is that obviously there are a number of different ways to expose yourself to gold and silver. We can trade gold or silver stocks or shares, or share CFDs. But the disadvantage of doing that, if you're interested in precious metals, is of course that you've got other things going on. So you've got company risks going on, as well as the currency issues related to the country that produces that particular sort of quantity of precious metals. So really, trading the pure gold or silver either through physically buying the asset, which of course is very expensive these days, or trading using futures contracts or CFDs of futures contracts is not a bad thing to have a look at, or options, of course, as well, for those of you who are familiar with options. And really, success in trading any asset is based on the identification of what's happening now in terms of trend, when that changes and when the move is over. Therefore, knowing key technical levels is critical. So going back to gold, it seems logical to look at these key technical levels. So if we use a daily chart, we're not going to go any tighter than that. So the first thing we know is that the support in at 1678, okay, or 1675, let's say. If we do break this level here, then the next level to the downside is not insignificant. It's around about $100 to the downside around this 1572. So certainly there's no, of course, it's easy to trade long or short with commodity CFDs as well, but certainly there's no evidence here that gold is going to come back and test that, nor is there the fundamental picture to say, well, look, it's going to break below that. Okay, the only real danger to that is what happens to USD, okay, which you see is still struggling in the short-term chart to break through that 200 MA. It's just sitting on it right now. Okay, if we should see US dollar going up, and this may be seen in treasury yields, then logic would say if there's an inverse relationship between USD and precious metals, that we'll see precious metals drop off. But bear in mind that those treasury yields rising are likely to indicate or likely to suggest the market is thinking some inflationary pressures. So it may be that that money goes into gold, of course. It could also go into cryptos, which we'll just have a quick check in on what Bitcoin's doing right now. I'm not going to buy it. We're getting a nice move on the US indices for tonight at this stage. But there's where Bitcoin is. Actually, let's put it on a daily chart. So it's quite a way off its high. So we've got that almost, if we look at the lows of today, almost 15% retracement from its record high, just over 60,000. But we see this is standard for crypto. So we get there we have a 22% pullback. There we have a 22% pullback. And in every case, we just seem to get the next round of buying coming into this. The interesting thing is we haven't had a massive move over here since then. So it may be that the Bitcoin trade, although most would suggest is just going to continue to go higher, it's not going to replace gold as an inflation hedge, but it is potentially a factor. So just sort of reference that. So of course, just as a little side issue, you're looking at potential entry into this. You've got two choices. You either wait until it bottoms, providing it bottoms higher than this level here. So if it comes down to here, starts to move up again, you can, those of you who have got a fairly risk tolerant approach could do what most people have been doing and buy on the dip. If you want to be a bit more conservative, then that key level at around about 60,000 would be the one to get interested in again. So using the same principle is in where are the key levels on gold. So what we've got now, always easier to see on a line chart. So we've got a classic technical picture. If we look at where the tops were there, you can see how this corresponds to where the top was in May. So we've got a normal technical picture going on here with a key price level that the market's suggesting that we need a move higher above that 1745 to get bullish about this. And this is a short term, okay? And the reason why I'm saying it's relatively short term is the fact that the thing is way below its 200 MA. So its 200 moving average is sitting at 1800. Its 50 moving average is sitting around about 1775. So in the short term, if it breaks that key level, then a logical first stage where it might slow or pause would be around where that 50 MA is now, around about that 1775, which is how it's got smashed through that in the early part of March. Okay, so that would be level 1 at that 1745, level 2 at 1776, and then level 3. If we pop it back on the line chart again, you can see the key levels that we're just going to put on here now. A lesser one at 1829, and then a real significant one where you know the long-term trade is back in around about 1870. So you can see as it goes up, there are steps which the market will look at to say, right, okay, this is a new, there's some new pressure coming in here. Interestingly, what I'll do is I'll just, for those of you who like fib lines, we'll just put a fib on this and just see where it's at now, because it did adhere to it quite significantly for a while there. Okay, so there's your Fibonacci level. So you can see it's bounced off the 61.8, and if you look at where we put this line at 1775, that's where the 50 fib is. So it's actually adhering to Fibonacci levels quite well, gold. So that's the other thing you can potentially have a look at. For those of you who are not familiar with that, then don't worry about it. Just use the key levels that I've indicated on the chart. So there's two ways you can play this, potentially. So starting with the premise or the assumption that gold may have bottomed out at this stage, but needs some impetus, some market sentiment change to move higher. In the short term, we're trading between these 2 points here, around about a $20 or $30 range, okay, over the last week and a half. So logic would say, if you take any trading logic, there are 2 points. It doesn't matter what you're looking at. We could look at a gold chart. We could look at euro dollar yen. We could look at Microsoft. We could look at the FTSE, and the rules of the game are the same. There are 6 ways the market moves. Okay, I'm going to zoom in a bit, and the 6 ways the market moves are uptrend. Well, let's change the Let's change the pen color. Uptrend, downtrend, trend reversal, which you see there and there. Trend pause, which we saw here and here, where it's continuing its merry way down. And there's another trend reversal. And where we are now is in congestion. Okay. And there are two places we can make money as a trader. Doesn't matter whether you're short term or long term, we're using trader as in its broadest context. We'll try gray, see if that works. Is we want to be in at the start of an uptrend. We want to have a signal to get out. Or if this is congestion here, okay, so we've got congestion and then congestion exit. So as it exits that congestion, we want to be in here as it starts a new trend downwards. So in this case, what we're looking for is a congestion exit in either direction. Okay, and that would give us the opportunity either up to that 1776 level or down to that 1678 level. So you may have profit targets here and here. Okay, so that would be approach 1. Okay, approach 2, I'm just going to raise all these drawings. Mike, what I'll do is, if you've got any things that you want to talk about further, I'm just going to put my email address in chat. So Mike, if you just pop me that, oops. If you just pop me that question to this as an email, I'll sort that out for you, mate. Not a worry. There we go. So in either case, we've got a potential short-term trade here and here. Okay, if you want the medium-term view, you would get rid of some of these lines. We'd get rid of this line at 1725. In fact, we'd get rid of most of the lines, and we would still have, you can see how important this level is that we're trading at around about this 1750 level. So if we break that, it's still an issue on the weekly chart, but we'd be going for a target of around about 1830. A break of that, and we could be looking perhaps to challenge that sort of 1900 level. Okay, so those would be our key levels on a weekly chart if you've got a medium-term view. Of course, that support still is the case around about that 1677, that longer-term support we talked about. So those lines are critical whichever way you slice it. And of course, if you trade a breakout strategy, so breakout from this congestion to the upside over this resistance line, you've got a nice level there where you put a risk management stop, and of course you would trail your stop up accordingly. I think there's going to be the points at which there are going to be major buying comes in are these. I'm just going to mark them on the chart. I'm just going to change this again. Change this to yellow. So the key levels, I think, will be, this one is one here. Okay, the next key level that might precipitate more buying is there, and the next key level is there. So I'm just checking in with the questions. Oh, you're welcome, Mike, no worries. So even if you're a medium-term trader, those are the levels at which we may see the technical picture drive some buying pressure to the upside. But of course, in all cases, we can put a risk management stop in place and profit targets if you want. Now, there's a couple of approaches to tackling this if we're using profit targets. I'm just going to raise those drawings again. So let's say we did get into a trade here, probably give it to around about that 1760 level. And so we can see the next key level up here. So what we would potentially do is, of course, set a profit target just below that. Why would we do that? Well, we know that there's going to be a chunk of people here with sell limit orders, which say if it retraces to this level, we think it's going to bounce. And so quite often that's why it does. We've also got a chunk of people sitting here and here with buy stop orders. Okay, these institutions and individual traders that say, well, look, if it breaks that level, it's across. And this is one of the reasons why this sort of breakout approach works, is that it takes in these traders here. What that does is it does two things: takes all their orders, creates the buying pressure. People see that initial move up, get excited, and additionally, everyone who's been short here is now thinking, right, I better close my short positions down. And so the closing of short position down adds further to that buying pressure and helps it move up to the next point. Okay, get cautious around this 200 MA, but exactly the same principle here. Some buy stop orders waiting there, and so that is going to help it move higher. Okay, now, so there are two approaches you can take with this. You can have an approach that says, right, okay, what I'm going to do is get mercenary about this. Actually, there's three approaches. First approach is I'm going to Stuart, can I come back to your question? It's a great question, mate. So there's two approaches to this. So we could use we could just get in here and make the decision that we're going to get out here. Okay, there's our profit target, and obviously if it moves in our direction, we trail the stop up, irrespective of, and there's a number of ways we can do that. I'll talk to you about a couple. Okay. The other approach we can do, and then what we can do is we can re-enter if it breaks the next level and do exactly the same here. Trail our stop up to lock in profit, and then out here, and then exactly the same here. So we're doing it in steps. We don't care. We're not really interested in holding. All we're interested in is being an asset that's going to make us money. We don't really care about whether it's gold or BHP or the Euro CAD, do we? So that's approach one. Okay. Approach two is simply to enter here, take it as far as it goes, and just keep on trailing your stop. Okay, that's option two. Okay, and I hope that you're all familiar with trailing stop. So what we're saying is this is our initial stop. If it goes in our direction, we just keep on moving it up, keep on moving it up, keep on moving it up until it eventually gets triggered. So let me give you an example of that. On a short-term trade, let's say we're using the 20, let's say we got into this short trade here. Okay, we sort of, actually, no, let's go higher than that. Yeah, okay, let's use this level here. You can see how it was support here and support here. So we could legitimately get into a breakout trade at this point here. Okay, so one easy method of doing this is to use the 20 EMA, which is this yellow line here, as our trail stop. So we just keep on moving it down using this, and ultimately it just happens to be triggered at that point. Okay, now there are various, for you guys who are more advanced, once the distance between the current price and the trail stops gets past your initial risk, then you can revert to the 10 EMA, which may happen on this. So we might actually revert at this point when there became a big gap down to your 10 EMA, in which be there. So that's a trail stop on that. The other simple way to do it, which I'm really liking at the moment, and something that we've been teaching quite a lot on in a circle, is using just the MACD signal line. Let's just see where this would have been triggered. So we stick a MACD on this, Now we're going to use a 10 and a 20 because it's 10 and 20 we've got on there rather than the default 12.26. But it doesn't really matter a great deal. But essentially what we're saying is if we're in a short trade, if the MACD signal line drops below the histograms, then we're out. So remember, we entered on this candle, sorry, this candle here. Okay, because that was the low. And so we'll be in this trade, in this trade, in this trade, in this trade. You can see there, the line has gone beneath the histogram. So we'll be out on this candle here, giving ourselves a, what's that? That's about a, I forgot what we got in now. There. So about a $39 win. Okay. If we'd done it on this uptrend, let's find an uptrend that would have worked. Gotta go. So used exactly the same principle. Let's say we got in on a breakout of this level here. You can see there was some congestion here. Got in on this level here. Then if we use the MACD signal line, then we'll be in, we'll be in, we'll be in, we'll be out on this bar here. Okay. So just before that big drop, which is sort of nice. So that's not a bad, nice way to trail a stop without having to do a lot of work about it. Just curious, if you were to place a pending order on a break of congestion, yeah, one, can I set it with a trailing stop? Yes, you can. Now, you can obviously set a trailing stop on some traders would prefer to do it manually and adjust it on a daily basis. So if they're using a 20 EMA, for example, you can set an automatic stop based on a particular point movement. Okay, so so if you enter a trade and you right click on it, you can see one that says trailing stop. Just make sure that you've got the points relevant to your instrument that you're trading, because if you're trading Forex, for example, 470 points is 47 pips. So just make sure you don't get that confused. You can check this easily by just looking at where your stop is. So let's say we're to place a stop here, our initial stop here. So that would be 3,574 points below that entry. Okay. So what you would have to do is mirror that with your trail stop. So what I would tend to do is do that, match your risk level with almost so you're trailing on every risk multiple. Okay, so perhaps at that 3,500 to the upside, you trade it to break even, or 3,500, you trade it to the first point, and so on and so forth. So that's how I would use the automatic on a pending order. And certainly that's worth doing overnight sometime. To clarify, this was set the stop prior to the trade being triggered, i.e. set a stop. Yes, absolutely. So you can, if we were to place the pending order on the, and it's the same MT4, MT5, we just do this. We do a buy stop order. Let's say we're to enter 2 contracts. So do a price. I know now there's ways we can do this price issue. Let's say it was 17.55. We can place, actually let's do it at 17.60. I don't actually want this to be triggered yet. And we'll place a stop at 17.20. We can even place a profit target at, we can use half. Usually what I would do is, one of the things we teach is perhaps using half an ATR above that signal line for our entry to reduce the likelihood of false breakouts. So you can see quite often wicks will be above this line, and maybe half an ATR below. So let's say our take profit is at 18.16. Whoops. Sorry, no, that's right. And then we place the trade. We can just check in on it. So you can see there, that's how the trade's been set up, all ready to go. And then once you're in the trade, then you can set your trail stop accordingly. Or once you've actually got it on your system, you can set your trail stop accordingly. Does that sort of make sense? I hope that answered your question, Stuart. Okay, so method one is just to trade the small gaps and treat everyone as a new trade. Approach two would be to trade it as just trail it until it comes back and triggers. Number three is what is an accumulation trade. So you say, right, okay, this is a key level. So what I'm going to do is I'm going to enter 2 contracts at this place. If we go up to this level, we're going to enter another 2. And if we break this more substantial line, we're going to enter another. We're going to enter another 2. Okay. So we can accumulate into the position as it gains strength. Now, of course, as we're doing this, we're still trailing a stop. Okay, so our initial stop would be here, and then we'll maybe trail it to here. So we're in profit on our first one. Then we maybe on entering that second one, then we maybe trail stops on both to this point. So we're in profit on this. So our only risk is the difference between entry and our stop on our first accumulation, and then do exactly the same here. So at this point here, we're actually holding 0.6 of a contract or 6 contracts, depending on how vigorous you want to go. But all of the time we're trailing stops on all of the positions. So many of you will have come across or maybe heard of the Trading Turtles project, which was an experiment done in the US decades ago. It's the same principle, and they actually did it on commodities. It's the same principle as that. Now, you're very welcome, Stu. So that would be your other approach as well. So that's approach 3. Okay, so if you can get 3 approaches there to potentially trade this, and of course they would work short as well. But at this stage, we're looking more likely to break that way than to the downside. We haven't yet, so you're patient until we've got a confirmed breakout of this level here. Okay, and as I said, with the weekly chart, you've got to you would set your stop, and let's just get rid of all these drawings. You would set your stop based on your weekly chart. So in this case, we would enter a small position, perhaps enter at the same place, but enter a smaller position with the stop. Let's try and drag that stop down. It's not playing. There we go. So we'd have a wider stop if it's a weekly position, and probably a wider profit target as well, just to give it a little more room to breathe. But obviously this will be a smaller position that would be open in here because of the distance. If we're basing our trade size on the size of our account, where can I find more information about accumulation? Okay, actually, we're actually covering this in a circle on Wednesday. So let me just pause the screen a minute. What I'm going to do is where are we at? So there's our inner circle. In our inner circle is for those of you who are less familiar, inner circle runs every Wednesday. It's aimed really at sort of advanced beginner to intermediate traders and obviously and beyond. And we're actually talking about accumulating into a profitable position, just with some new thinking that I've got on how to set that up. So if you're interested in that webinar, then feel free to rock up to that. So that's a Wednesday, 8 o'clock Eastern time. So I'm just gonna, you'd be very welcome to join that. It's a fantastic group, really participative, lots and lots of questions come across and comments. It's awesome to teach and great to be part of. So I put that into chat. If you want to be part of that group, you'd be very, very welcome. Okay. So let's go back to our presentation. So as I said, now on top of that, and in that session, you can accumulate and reduce depending on your feeling of. So once it gets past that third accumulation point and back towards those record highs, as an example, you may start to look at a reduction strategy, whereby you've accumulated into a position and then you start to reduce into a position, reduce the sizing into a position. But we'll just briefly cover that on Wednesday as well. So bottom line is, if we sort of pull all this together in terms of where you're at, so taking all of those factors into account, what's the medium and long-term picture for gold and silver? Well, much, of course, there is no compelling reason to suggest that gold is up for another run like it was last year. No compelling reason at all. However, there could be, it's not unreasonable to suggest that from a technical point of view, it's perhaps been in an oversold state, and we may get some money coming back in, particularly if we see some inflationary pressures come back into the market, not from a thinking point of view, but some actual data. So if we see those CPI figures starting to rise, then that could say, look, as a medium-term trade, this isn't a bad idea. In the short term, we've got the technical picture with some clear lines in the sand there. Outside of that, we've got no other, looking at those other four factors, we've not actually got a big compelling argument for it moving higher or indeed lower. Much will depend on, as I said, on the bond yields and perceived inflationary pressures. And so I guess for you as individual traders is I've given you three approaches potentially on how you could play this game with precious metals. But of course, you've got to be in a position to be able to trade it by having an account that's funded, etc. And of course, you've got to plant your flag in terms of which of those approaches might work for you. And of course, write them down in a trading plan sort of style to allow you to be sufficiently clear about what you're going to do and disciplined in execution. So really, those are the bottom line questions. I'm just checking through here. What else have you got coming up from an education point of view? There's a couple of other things later on in April, but we do run a live market update session on a Tuesday and Wednesday lunchtime, if that suits, which looks at what's happening not only in the FX and commodity markets, but also shares as well. So a lot of guys rock up from a share point of view as well, and we do a chart of the day for both FX and shares. So I'll just post that in. In the chat box as well, so you can register if you want to. Okay, Mike, take care. Talk soon, mate. Talk soon. Okay, so how can we help? Well, obviously, the first stage is to have access to markets. If you've not got a trading account which allows you to trade commodity CFDs, or so an MT4, MT5 with Go Markets, then of course we'll be happy to help. Just drop me an email and I'll help as I can. Stuart, thank you very much, mate. That's very kind feedback. Obviously, the advantage of gold and silver CFDs will give you access to this at a fraction of the price, although obviously there's been some massive changes in terms of leverage allowed, but that's another story for another day. And obviously, if you're interested in trading the gold stocks or silver stocks, then of course you can do that again at a 5-to-1 or a 20-to-1 leverage, depending on your type of account you've got. And obviously, we've already talked about the education that we offer every level of trader. So knowledge is power, and you get this for free from Go Markets. There's no charge at all. So rock along to those sessions, get part of Inner Circle. As I say, it's a really good group to be part of. And we update the topics every week. So then you can, it's a one registration covers all, likewise with the live update actually. So you don't have to keep registering, and then you can decide whether it's a topic of interest or not to you. And as I said, we discussed gold and silver and what the latest is in the immediate prognosis at all of those sessions. So it'd be fantastic to have you along to any of those. Karen, thank you so much. That's really kind. So ultimately, of course, as with anything, you've got a choice to make. As I said, there's my email address there. I'm happy to field any questions you've got. If you do the accumulation plan, how would that be affected by the new ASIC rules if you don't have a pro account? Might be better to go with a trading stop. Greg, there's two components to that, of course. Firstly, of course, it depends on the size of the position that you're entering, but you're absolutely right. You need to keep an eye on margin should you be entering additional positions. So perhaps it is worth, if you've never traded gold or silver CFDs before, then what I would suggest is perhaps don't go down the accumulation model just yet. Get used to how the underlying asset moves, because everything is priced slightly different, and that it takes some time to get used to how, because if you enter 0.1 of a contract on gold, it's very different to entering 0.1 of a lot size on a FX position in terms of how radically quickly it moves. So ideally, if you've got a live account, just test it on a demo first, just to get a feel for that. And then, of course, likewise, when you do your first trade, perhaps just a baby trade, dip your toe in the water just to get the feel for how it moves. Perhaps with one of the things that we've discussed today would be good. And then, of course, you can make the decision as to whether you're going to, which of those three approaches would be good for you. So, yeah, that's great question. So a great comment, Greg. I'm delighted that you brought that up. And of course, look, the other thing to say with, of course, there are going to be some changes that are going to be actionable from 29th of March. Of course, many of you that doesn't apply to because you've got an overseas account. And of course, it doesn't apply if you're a pro trader. But if your account is in Australia and you are going to be affected by this, then in terms of the leverage you can use, then it's not a line in the sand. It doesn't mean you can never be that. So it might be that you can qualify from a knowledge point of view, but you've not quite got enough trades under your belt yet to be able to qualify on that particular criteria. So don't feel as though this is it. If it's not done now, you can't do it. Of course you can. Yeah, hope that helps. Alyssa, you're very welcome. Cheers, Luke, and yeah, you too, buddy. Okay, guys, well, that should just about cover it today. I hope I see some of you on some of the sessions that we're running over the next week or so. It'd be fantastic to see you there. A real pleasure and a privilege to get this time with you today, and thank you so much for your participation. No polls, none of that other stuff, and of course, as ever, trade safe, manage risk as well as manage profit, and that'll always serve you well. Have a plan, trade a plan, review your plan as a basic mantra as a trader. Well, take care of yourselves. Enjoy the rest of your week and your weekend when it gets here. And thank you once again. And feel free, please, to drop me an email. Even if you got some feedback about today, about what you felt, did it hit the mark in terms of what you're expecting? Has it been useful? It's always great to get just a bit of feedback. Joe, you're very welcome, mate. Yeah, okay. Cheers, Greg. Thanks, John. All good. Bye-bye for now.